Good morning, everyone. Steve Ganz here with a new trade in the Start to Finish series. So this is going to be a double calendar. Now, this is not a trade if you're not familiar with trading time spreads, if you're not familiar with trading calendars. This is not something to start with. That said, it's a very valuable trade from my perspective around earnings because it gives you such a huge reward to risk ratio in certain instances. If you can find this type of trade that I'm actually sharing here this morning. So let me just kind of walk you through the premise on this and take a look at it. And I should also say, please, if you like this sort of content, if you find this to be of value, make sure you put a note down below. Let me know, like, subscribe, and let me know if you find this of value. That really helps me out. Because some of this stuff I get a little worried that it might be a little bit too advanced. But I try to break it down as simply as I can. So let's go in and take a look at a chart. Okay, so here's a chart of Target. Target has earnings coming up here. Let's take a look. It's on Wednesday before the market opens. So when the market opens on Wednesday, Target's going to be flying all over, up and down here. They're probably going to have a conference call during market hours after the market open, most likely. So that will further cause the price of Target to fluctuate up and down. But looking at technical analysis under normal circumstances, barring something really bizarre happening, I would expect Target to probably trade somewhere between maybe the 115 range here and maybe down to around the 103 range. So 1015 to 103, or let's just call it a 10-point range, 115 to 105. So if that's kind of my premise on Target, if that's the range that I would hope to expect, barring anything unusual happening in Target, that's what I'm going to do here with calendars. I'm going to do a call calendar at 112, and I'm going to do a put calendar at 105. So what is a calendar? Well, a calendar is a time spread. And what I'm doing here is, let's just take the put side here. So I'm going to sell the 105 put, and I'm going to sell the closest one in this case, which is this Friday's 1117. I'm selling this for $3.33. Now, the volatility is high on this. Take a look at this. The volatility is at 104 on this particular strike. That's because we have earnings coming up. So the closest strikes to the earnings date will tend to be the most volatile, and they're going to tend to have the highest price associated with them. That's good news if I'm the seller. If I'm the seller, I want to get as much for an option as possible when I'm going to sell it. Now, I don't want the naked risk of that option, though. I don't want the risk of just selling a put. So because of that, I'm going to go and I'm going to buy the exact same strike put. I'm going to buy a 105 put, but the 105 put, because it's further out, it's a week out, it's going to have usually lower volatility. We can see here the volatility there is only 67%. So, and that's because it's a little further away. The people that are buying the protection on Target, the people that are buying those puts because they have a fear of what the earnings in Target might do if they have a position they want to protect, they're going to buy the closest ones right after earnings is generally what people tend to do. So look at this. I'm going to spend $3.45 to buy this protective put. I say $3.45. Actually, let's look at the bid-ask spread. It's probably going to be closer. Well, in my case, I've logged the exact price I paid. This is a live trade of mine, and I paid $3.55 for this long put, and then I sold this short put for $3.33. So nice tight spread there. It didn't cost me much for this trade, the difference between the 333 and what was it, 353? So 20 cents or $20 for one of these guys. So my total risk in this put spread was that difference. Again, I think it was $20, but if it was something slightly different, it wasn't much more. So that is my total risk in the put spread trade, is the $20. Now, I like to do this with kind of a range, with a spread. So that's why I'm doing also a call spread on the upper side. My premise is that I don't really think that target will shoot much above that 112, 115 range, which is going to be right around in here. So I'm okay selling that. So again, I'm selling the 112 call. I took in $2.27 for that. We can see the IV isn't as high there. IV will usually tend to be higher in puts. The reason is that investors will buy puts to protect a position. They don't usually buy calls. To buy puts, there's a number of reasons to buy puts. You're a trader, and or buy or sell, I should say puts. You're a trader, but the most common reason people buy puts is they're going to protect a position they might already have in target. They might be afraid of target tanking, so they're going to come in, they're going to buy insurance. So generally speaking, as you go into earnings, puts will normally get driven up, higher volatility than the calls do for that reason. But anyhow, in this case, volatility was 82. I sold this call for 227, but again, I didn't want the unlimited risk that went with a naked call, so I'm also going to buy a long call for next Friday at 112, and I spent $2.54. So I spent $2.54. I sold one for 227. Again, whatever that difference is, it's a little early. I haven't had enough coffee for my feeble brain to handle that, but call it roughly 20 cents, 25 cents, somewhere in that general range. So I'm going to pay $25 for this call spread here as well. So the combination of those two gives me a total risk in this trade of essentially $50. That is my total risk in the trade. Now, let's look at my reward side of the equation. So on my reward side of the equation, after earnings are announced on Wednesday, if this stays within this general range, I would expect that this trade would likely have about 100% profit in it fairly quickly. Again, if it stays within the range. If it blows out to the upside, if it blows out to the downside, I could be looking at a total $50 loss come Friday when these short strikes here expire. I have to understand that. I have to be prepared for that. I have to also know this is very, very important with time spreads, with calendars, with diagonals. This particular max loss only comes into play if I close out both sides of this trade at the same time. If I am foolish enough to let the short strike expire and I have an open long strike here, lots of things can happen that aren't good. My losses can be significantly larger because if I take this short strike out of here, let me just exclude this for a minute, you can see now I am one-sided in that part of the trade. My losses could be as much as 350. Of course, my gains could be much higher too, but that's not how I'm trading a calendar in this case. I am trading this as a pair. And when I say as a pair, I'm trading these two as a pair and these two as a pair. If this one expires, or when this one expires, this one needs to come off too, unless you really know what you're doing and you have a very specific plan for leaving it open. So, again, this is going to be a real interesting trade. I wanted to share it with people. It was a very inexpensive trade. It's a good one to learn from. On Wednesday morning, my goal is going to be to open up this P&L diagram here, and I'm going to watch on the open, and I'm going to show people how this tent's going to shrink in when volatility comes out of all of these options first thing on Wednesday morning. We're going to see this tent. It's going to shrink in from all sides, But if I'm still centered here somewhere in this general range, I should also have some fairly nice profits fairly quickly. Again, if it blows out to the upside, blows out to the downside, I'm looking at a $50 loss come Friday. So and again, I have to close both my short strike and my long strike to be on the safe side, unless I really know how to deal with just a long strike for the following week. I have to be okay and understand what it means to just leave that one strike open. So hopefully you guys found this interesting. Again, please like, subscribe if you find this of interest. I will say that time spreads, calendars, and diagonals are one of the most difficult to understand trades, because rather than just trading a spread or strikes that expire at the same expiration, time spreads, the modeling on time spreads, the tent changes all the time. If volatility goes up or down, you see that tent size changes dramatically. So that's one of the oddities about the modeling of time spreads when you have options that expire at different points in time. Now, one of the cool things that was added in OptionStrat here recently is that I can come in and I can look at the November strikes separate, or excuse me, I can look at my two expiration dates separately. So what I want to happen in this trade, just to clarify and show this to you, because I can model it now in OptionStrat. What I want to happen in this trade is I want the Novembers, these early ones, the November 17th, these early ones, I want them after earnings announcement. I want the volatility to drop considerably in those. Now, it's going to drop in both of these, but because this is so much higher, the theory with the time spread is that this might drop to 60, somewhere in that general range, maybe lower, maybe it'll drop to 50 or even 40. And this one might only drop to, 50 or 40. It won't drop as much. So that's the theory behind it. That's what we would like to see. So if that happens, if we look at our November 17th and those drop some amount and the longer ones don't drop as much, look how much profit comes into this trade quickly. So that's the ultimate goal here. That's what we're looking at, is that we want our front strikes, our 17th dated strikes in this case, to have the volatility drop out of them faster than the volatility drops out of these back two. And again, usually when you have a binary event, like an earnings trade like we have here, that is how it plays out. Regardless of what the news is and whether the market shoots up or shoots down, the unknowns become known at that point, and the fear and volatility will usually drop out of the front strikes first. So that's our goal, that's our objective, and we'll see how this plays out. So thanks everyone for staying around, and look forward to your comments below. Take care.